Hello, everybody. I heard that somebody just texted me saying that the audio wasn't quite working correctly, and I just figured out why. Because it helps when the microphone is over by where you're talking. All right, so tonight we're going to talk about Social Security, and we're going to talk about how you can increase yours by 20-30%. And as we go through here, please stop me and ask me any questions that you might have. And let's go ahead and jump in. First off, disclosures. I am an investment advisor. I do not work for the Social Security Administration. I will be talking about Social Security, obviously, tonight in a large degree. But more importantly, I am not a CPA. We will talk taxes a little bit. And I am also not a, again, I don't work for the Social Security Administration. So I wanted to just let you know that on the disclosures. Legal department always make sure I go through that. So tonight, really think of this as you can optimize your Social Security in one of two ways. All right. The first option is you can download this workbook, and you signed up for this. So this workbook is yours. You'll have the link here in just 1 minute. Oh, sorry. Let's go ahead and mute that again. You go ahead and download that, and you can go through here, and it's self-paced, right? So this is available to you if you decide to do it that way. Or the second option, and of course that's going to keep popping up. Second option is to have us do the heavy lifting for you. So for those of you that say, you know what, I really want somebody to kind of put this together for me in a package. We'll not only give you the Social Security workbook or figure out what is best for you, but we also will compare your benefit with, say, a spouse's benefit or a deceased person's benefit, maybe spousal benefit, but we're going to coordinate this benefit for you. So why is Social Security such a hot topic? The main reason is there's so many people starting to get or qualifying for Social Security. Every day, 12,000 baby boomers turn 65, and that is quite a few people. All right. So there's about 3.5 million people per year. The issue here isn't necessarily the number of people who are taking money out. Obviously, that's a big component of this, but it's also the fact that we don't have as many people putting in. You know, when Social Security first came out, there's about 26 people putting into the system for every one person taking out. And today it's about 2.5. So 2.5 people are putting into Social Security for every one person taking out. And that's why it is essentially bankrupt. And yes, it is bankrupt, but don't worry, they have ways to fix it, and we'll discuss that here in just a minute. So what does Social Security mean to you? Essentially, what it means to you is that, well, here's a couple stats, and then we'll get into exactly why we want to maximize it for you. 65% of people rely on Social Security for more than half their income when they retire. And since about 85, you know, most corporations don't give pensions anymore. So if you did work for a big company like AT&T, some of the government agencies, they still have some small pensions, although I don't think AT&T still does. But if you work for a government agency, municipality, you still might have a pension. But even then, they're under pressure to go ahead and do away with these pensions. They more and more are coming to the table and offering 401k plans, which essentially, if you're a government institutions, 403b, 457, 401a, B or 401a, and that could a type of plan. But they want you to save for yourself. They don't want to be on the hook for these retirement benefits because, after all, it does affect a city's budget, municipality's budget, a county budget, and even state budget, right? Depending on where you work. So they want to get away with that or get away from that. And the way they do it is they just offer you a plan where they match, and it's up to you to save for your retirement. All right. So some of the questions you want to ask yourself is, and for those of you who missed the very beginning of this, we will have a Q&A at the end. But wouldn't it be nice to get an extra 20%, 30% out of your Social Security? So that's really what we're going to encompass today. We're going to show you how you and your family can get 10, 15, 20%, up to 30% more. And we'll show you the steps to do that. All right, so back to the slides. The question you ask yourself, this is all about insuring, right? So you insure your home insurance, you have car insurance, you have health coverage. But how do you insure your retirement? And the main way you do this is twofold. One is you have to save for your retirement. That's part of the battle. It's tough to save with inflation and all. But two is you have to make sure you're maximizing your Social Security, because that is your insurance policy to make sure that you have an income after retirement. Now, again, going back to when Social Security first came out, the average life expectancy for somebody was 65. So there weren't that many people living past 65 in order to collect on Social Security. Whereas today's average lifespan, depending on what you read, but it's around 78 to 80. So we're having to cover everybody on average for about 15 years. And obviously there's people who live longer than that. And I will show you that. So really, Social Security is to cover your expenses for longevity and make sure that you don't run out of money. All right. So here is the oldest living person here in the United States. You see, she's 117 years old. I'm not sure if we'd all want to be 117 years old, but I hope the slide hasn't changed, by the way, for a while. Hopefully it doesn't change anytime soon, but 117 years old. That's a long time to be thinking about having to live on your income, or what you have in the bank, and making sure that your Social Security is maximized. All right, so our focus today is really strategies for married couples, the ground rules for benefits, and also what are the options if you are married and divorced. And finally, we're gonna take it up with what are the options for widows and widowers. Oh, and I did add one little component to this, so let me throw that up here, is taxes. All right, so it's interesting, but Social Security is taxed in an odd way. And there is a strategy, and actually a 33-page booklet that they use to basically figure out how much of your Social Security gets taxed, right? And whatever that is, it gets taxed as ordinary income. So if you're in the 37% tax bracket, your Social Security is getting taxed at 37%. If you are in the 10% bracket, then your Social Security is getting taxed 10%. But the interesting thing is, if you can keep your income under a certain threshold, you can, in theory, go into retirement paying zero in tax. That's right. I said zero in tax. That doesn't mean that you're broke and you don't have any money, but there are certain loopholes here that I'll show you here in a second that you could use in order to maximize your retirement. All right. So the basics of Social Security. How do you qualify? Social Security covered job. So for those of you who are getting Social Security, it is the money that you have paid in for your own. There are 40 credits or 10 years of work service. So it's not necessarily 10 years of work service, but it's the 40 credits. In other words, it's a quarterly credit. For every quarter that you earn over $1,500 a month, you can earn 1 credit's worth of Social Security. And again, they average the top 35 years. They do account for, they index it for inflation. And there are certain exclusions for certain government jobs, government pension offsets. I do know that we had a lot of teachers, instructional, non-instructional, in the Florida state system on this particular call tonight. So this does not pertain to you. If you're in the Florida retirement system, even though you are in theory a state, pension worker, there is no government offset for you. This is more for governmental agencies, not Florida retirement system. All right, so how does Social Security work? You are contributing 6.2% of the money you earn, and your employer is putting in 6.2% for a total of 12.4%. And today's contributions cover today's benefits, not future benefits. So unlike some other things that you might be doing, like a 401k or 403b, the money you're putting in there today doesn't fund your future benefit. The money you put in there today funds your neighbor's benefit, who is already taking Social Security. So that's an important distinction in the 401, or I'm sorry, in Social Security. So what about solvency? We do talk a little about this, and you hear it in the paper. It's been an election year, so they always bring this up. You know, every party wants to get rid of Social Security, but that's not necessarily true. However, I will say that it's not a good investment for the government because they simply going to run out of money. So it's funded up until 2035, but beyond that, it only has 83 cents on the dollar. So they have to fix it. They can increase the minimum retirement age. They could increase the full retirement age, increase the amount they do payroll tax, or they could simply reduce the benefit. So they could do a combination of all this, right? So they could say, instead of being 62 for the minimum, they can make it 64, 65. By the way, any of these changes that they're going to make that probably for 20-year-olds, maybe even 30-year-olds. Certainly they wouldn't do it for anybody like us in the 50s, 60s, 70s. They just, you know, again, you're a voter. Most people, as you get older, vote. They really can't do anything to reduce that. But they could, in theory, decrease it. So as you get older, you know, you get 8% per more or more added to your Social Security benefit. And there's three distinct Social Security benefits. Again, there's a benefit that you get based on your work history into Social Security. There is also a spousal benefit that is 50% of your spouse's benefit. And there's also a widow or survivor's benefit. And that is based on that's based on 100% of the surviving spouse. Now, they can lower that, and I'll show you that here in 1 second if you are looking for spousal benefit. Now, you could file a voluntary suspension in order to fix a mistake. We did have one teacher here that I was working with in Palm Beach County. She for some reason, Social Security had missed 2 or 3 years that she had earned because she was in what they call drop, which is essentially a retirement program. But they didn't know that she was supposed to be getting, or she was getting income those years. So she went back and fixed it. You have 1 year in order to do that. And you can also rescind your application. For instance, if you file within a year, let's suppose you get a big inheritance. I had a client do that. He tried to rescind it. It was during COVID, which meant that he was having a hard time finding somebody to fix it for him. So that necessarily didn't work out. And considerations for married couples. Now, to qualify, you have to be married for at least a year. Primary worker must have filed. The next line is that you can't, well, you don't qualify for a benefit if your own benefit is more than half of your spouse's. So if your benefit is $2,000 a month, your spouse is $2,200 a month. Half of your spouse's is $1,100. You get $2,000. They won't let you file for half of your spouse's because yours is higher. They essentially look out for you, and you get the higher amount. Up to 50% of your spouse's PIA. Primary insurance amount, that's the amount that they figure when you turn your full retirement age, 67 for most of you. So again, here's a quick little example. Here's one thing that I want to point out, though, is if your spouse files early, it not only hurts you because you get a reduction in the amount you get paid, but it also hurts your spouse because they don't get necessarily 50% of what you would get here. They get 50% minus 50%. Well, they get essentially 35%, 40% of the total benefit that your spouse would normally get. So the point here is that it not only does the primary income earner get a reduction, but also the spouse gets a primary reduction. So you really want to think about this if your spouse is trying to get, you really want to shoot for that 66, 67, because that way your spouse gets the higher amount as well. By the way, so if you decide to wait, it doesn't do your spouse any good because first off, you have to file. Second of all, your spouse only gets 50% of this amount when you turn 66 in this example. They don't get half of 108, half of that, half of that. They only get half of here. It gets capped at this amount, and you can't get any higher for spousal. All right. So survivor's benefits at the death of the first spouse. A couple of things you need to be aware of. His or her own benefit maximum. This is the maximum. Okay. The benefit of the deceased or a little bit less of the primary insurance amount if they filed early. So just like if you were married and the primary income earner filed early, it affects the spouse. Same thing here. Primary earner takes Social Security early. It does affect the spouse. So what are some of the common mistakes? Higher wage earner files early and both delay past full retirement age. You don't necessarily want to do that. What you really want to do is talk to somebody that knows Social Security. Sometimes they'll help you, sometimes they won't. I found that they give better advice if, for instance, if you're widowed or widower, they will try to help you. First off, they're giving you information that is yours, but second of all, the spouse has passed, and so they're not worried about violations of giving out information based on individuals. So, considerations for the divorced. The divorced spouse benefit. Again, you have to be married for a total of 10 years, not currently married. Same amounts and reductions apply for regular spousal benefits, even though it's divorce benefits. And independently entitled, meaning you're divorced for 2+ years. So some of the common questions we hear from those who are divorced, do divorce benefits affect the current spouse or their dependents? The answer is no. And is my ex-spouse notified by Social Security? No. So don't worry about that if you are filing and you have an ex-spouse. They do not know, nor does Social Security let them know that you're filing, because that's your benefit. Even though it's based on your spouse's benefit, it's not anything your spouse can control. So don't worry about that. Some of the qualifications is that you need to be a widow or widower, 60 years old or older, unmarried until age 60. This is a big one that sometimes people miss. You can't be 59 and get remarried. Your widow benefits will go away. And you had to have been married a minimum of 9 months prior to death. They do make some exceptions. If you get a married couple, let's suppose one's in the military, they get shipped overseas and get killed in action, something like that. They will award the benefit. Now, widowed client example, John never elected and died at age 64. So his benefit of full retirement age would have been 2,150. So this client example is really, if somebody come to me and said, okay, I want to try to figure out how to maximize my benefit, my Social Security, this is my situation. How would I do it? I said, okay, well, let's get your information. So she was married. Her spouse passed at age 64. His benefit would have been 2,150. She's 5 years younger, so she's age 59, and she remains unmarried until age 60. Jane's estimated benefit would be 1,197. So just foreshadowing here a little bit. There are 3 options when you look at this example. Okay. First example is this. She could file for widow benefits at age 60. She can collect the 1,537, and she is expected to live to age 85. So she'll make 461,000 in benefits. Option 2, we say, if you filed for only your retirement at age 62 and then switch to the widow benefits at age 67, you'd end up making $538,000. So it's about $70,000 more. And then option 3, I say, if you file for your benefit at age 60, you'll get the $1,537. And then when you turn 70 years old, we'll go ahead and get $2,108. And so we see here that in Social Security benefits, you'll get $563,000. So you can get $460,000 to $563,000. If this were you, which one would you pick? All right, 560,000 seems a whole lot better than 460, at least in my math. So most people would pick the later benefit. Not only that, but see here, she actually benefits in this way too, is that at age 60, she was able to go ahead and collect her benefit instead of waiting to age 62. So she actually got 2 more years. Can you work and still collect? Yes, but you can't earn over 22,000, or the government takes $1 for every $2 over the limit. So if you plan on making $40,000 in retirement, do not start Social Security, because essentially if you make $40,000 or more, you won't get a benefit, even though you've already qualified for it, because 20,000 of this will be taken back if you made 40,000. And I'm using an estimate here, but you don't want to do that. And I've had people try it. So let's move on to the taxes. Again, I talked about a publication that the IRS comes out with. It's 33 pages long, and it's provisional income. So this really figures out how much of your Social Security gets taxed. It's not what tax bracket you're in. All right, that's separate from what I'm talking about here. It's how much of your Social Security gets taxed. So it's called provisional income. They take half of your Social Security. In this example, this person earned $24,000 in the year. So you take half of that, which is 12, and then you add on 30,000, which is how much they made by, investment income or what have you, CDs, bonds, selling stocks. So in total for this calculation, it is $42,000, right? So it's $42,000 in provisional income. So you say, all right, if I'm single and I make $42,000, how does that affect me? Well, 42 is more than 34. So 85% of your Social Security gets taxed. You still get 15% that isn't taxed. And 42 is below here, is in between. So if you're married, then 50% of your Social Security gets taxed. So in that example, 50% of this 24, which is 12, gets taxed as ordinary income. In the other example, it would be 85%. So, excuse me. The one thing I wanted to show you here is that there are loopholes to this 30,000. So if you made $30,000, this is income. However, if you had made income in one of these 3 types of income accounts that do not count. All right. It doesn't account for this $30,000. One is Roth distributions. This is the easiest one to do because it's very simple. You got a Roth account, you had it for more than 5 years, you take money out, it's tax-free and income tax-free, right? So you could have $50 million in that account. You could take $1 million out a year for the rest of your life. It would not increase the taxes on your Social Security because they do not count Roth distributions as taxable income when figuring out how your Social Security gets taxed, right? 2 is depreciated real estate, depending on how much depreciation you get and things. This one's a little trickier, a little more math, but accountants do it all the time. And you hold an asset, you're depreciating it, and it offsets some of the income. Again, I'm not a CPA. I have prepared taxes in the past, but you would need to talk to your CPA about how that would work for you. And 3rd is cash value life insurance. So there's 3 carve-outs that you are allowed legally to decrease the amount your Social Security gets taxed, and that is these 3. So sometimes our clients use 1, 2, or all 3 of these. if you are a high income earner and you are living in New York or California, Illinois, any of these high tax states, you really want to take a look at that. We approach this thing as for every dollar you don't pay in taxes is another dollar you get to keep in your account. So there are ways to do Roth conversions. There are ways to do real estate, commercial real estate, and obviously cash value life insurance is another way that we do it. All right. Oh, I wanted to touch on this. So municipal bonds, for those of you who buy municipal bonds thinking that it's not taxed, it's not taxed at the federal level. However, it is a calculation that gets thrown in to figure out your provisional income. So if you had $30,000 worth of muni bond interest, it does push up your tax bracket. Actually, let me go back here. It does factor into this calculation. Only those three that I shared with you: Roth distributions, depreciation on real estate, and cash value life insurance. Those are the only three that do not count. All right, so here's a quick client example. So there's a married couple. They need, or I'm sorry, they got $34,000 in Social Security if they start at age 62, meaning they start early. They start retirement. They've got $750,000 in 401k assets. They've got, or we're going to assume they're going to get 6% annual return and 3% inflation. And they need $70,000 a year in income after tax in order to make their income budget. They're going to be living to 86 and 89. And so I get somebody that comes to me and says, hey, this is what I kind of need. What's the best way to go about it? They're thinking, we should go ahead and file for Social Security because that way at least we have $34,000 coming in and they don't have to use up their $750 in retirement savings. We say, okay, this is the strategy. Well, let's take a quick look. First off, again, this chart here, we put this together for folks that want us to do the heavy lifting for them. The blue line is if you take Social Security early. The orange line is 401k withdrawals. The red line is how much money they needed. Remember, it starts at 70,000 and goes up 3% every year. And the orange above the red line is taxes. It's pretty simple. This is a simple little diagram we use. But you notice here, once you hit year 23, there's an issue. We see that the line stops. So, and we don't see any more here, meaning that this couple only is getting Social Security. What does that mean? That means that you ran out of money. That is not good. We do not want you running out of money. So here's cash flow that's optimized. And we say, okay, take the same situation, same scenario, but we say, what would it look like if we optimize it and you started Social Security later than sooner? Well, the first thing you'll notice is that these orange lines are front loaded, meaning that you're using up a lot more of your 401k initially in the first 8 years. All right. But you'll see that year 23, 24, I mean, you're still getting income for all these years here, whereas prior you were running out of money. All right. So you got all the income here. Only because we optimize. You say, well, what's the difference? How does it really make that big a difference? Well, first off, you'll see that you made about 30% more in your Social Security. So about 186,000 more in your lifetime value. Second is that you'll see you had income for 14 more years. In other words, you didn't have to go live with your kids 14 years earlier. You roughly had saved $35,000 in taxes, even though you had a 14 more years of additional income. So just these three things alone is enough for a reason for some folks to want to maximize their Social Security. And you can see here, this plainly says that, hey, you maximize it, you get 3 benefits out of that. And what about your statement? So there are no cost of living increases to your statement. It's going to assume that you're going to work to age 62, full retirement age, or age 70. It's your record only, and they don't give you much advice. Your Social Security statement just gives you what you're going to get. does not coordinate the benefit between you and a spouse. If you are getting widow benefits, it does not coordinate widow benefits. So you really need to talk to somebody and coordinate that benefit. Again, we talk a little bit about the Roth rollout strategy. Married couples. Oh, so this is one that I did for married couple. They had about 1.3 million in 401k. And because they were government workers, it was actually a 457. But for those of you who are not government workers, it's similar to a 401k. But they had about 1.3 million. And you'll see here that this is the amount that they were having to pay in taxes later in life. So here, as they got older, they were having to write checks to the IRS for roughly $500,000. Now, it doesn't mean they didn't have it, because obviously they did. But that $1 million in 20 years, the RMDs are what the government makes you take out of your qualified accounts, required minimum distributions, equals up to $500,000 a year for this married couple. So there is a strategy. We say, geez, that's a lot of money to be paying in taxes. We do have a strategy. Would you like to take a look at it? And I said, sure. So we say, okay, well, if we do some sort of Roth conversion, remember, this is just Roth conversion. This doesn't take into account any life insurance. It doesn't take into account any real estate. This is just straight Roth conversions. We say, well, in order to avoid these higher tax rates down the road, what we can do is that we can do Roth conversions over the next 5 years. I'm sorry, 6 years. And so you will pay a little bit more up front, but it'll save you all the green. So the green is paying up. I mean, the red's paying up front. The green here is what you save. You say, all right, well, it's great to look at this chart, but what's the numbers? Do they really even save any by doing Roth conversions? So this right here is an estimate, of course, but this estimated savings is over $1 million. So they have a little over $1 million. If they do Roth conversions, you can see here that they would save $1 million. So that's the power of doing some of these things and putting or spending the time to do a little bit of analysis on them. All right. So the strategy results is that they save about $1 million in taxes. They increase the tax-free net worth over $2 million. In other words, excuse me, this is money that they are giving to their children or some sort of charity or wherever they want to do, but they were able to increase their net worth tax-free, meaning their kids don't pay taxes on it, by over $2 million. I'm sorry, the tax-free net worth for themselves is 2 million. And then the inheritance at the end of their life is around $4 million. So they increased it substantially from 1 million to $4 million tax-free. So they plan on giving some charity and their kids and so forth. So now you have really two choices. One, again, is that you can download the workbook at www.maxoursocialsecurity.com, or you can schedule a time. If you go to this website and download the workbook, I want you to download the workbook if you come see us or not, right? You signed up to get a workbook. This is how you get it. You just go to www. If you are on the Zoom call, you just on the Zoom call, go to Max Our Social Security, www. You got to put www in there. maxoursocialsecurity.com. If you are on Facebook, you simply click on the maxoursocialsecurity.com. It takes you right to the form. And in the form, I'm going to go ahead and jump over to where you fill out the form. So if you fill out the form, you say, yeah, I want to talk to us or have our team do this analysis for you. Go ahead and click yes. And that'll pull up our calendar. You can just pick a time that works for you, and we'll be more than happy to help you through that. So what you get if you do decide to come see us is you will get the Social Security analysis done by our team. You'll also get the workbook, which you're going to get the workbook either way. So that's good. And we'll also do this Roth rollout strategy for you. if you have more than $250,000 or more in IRA assets. So if you have less than $250,000, it doesn't really help you too much. But if you have more than $250,000 on up, $250,000 or more, most of the time these strategies help save you income tax. So I do appreciate everybody being on the call. If there are any questions, go ahead and you can pop those in if you are on Zoom. Let me go ahead over here to Zoom. Yes, so I got a question. If it says, I won't use your name, but it says if I was married twice for 5 years for one, 12 years for the second husband, you can get the benefit for the one that you were married for 10 years or more. You can't get the benefit if you're married under 10 years. So now, conversely, if you were married twice for, say, 11 years each time, you could get the spousal benefit for either one, be your pick. But you got to be married for 10 years or more to get spousal benefits. All right. Oh, one of the teachers is asking a question. So this is more specific if you're in the Florida retirement system, but it asks, can you get widow benefits and also your own benefit? The answer is no. So the question is really, do you get widow benefits and then can you stack your own benefit on top? The answer is no. The Social Security Administration only lets you get one benefit, but they do allow you to get the maximum benefit depending on which one of you is getting more. So yes, you do get one of the two benefits. You can't stack benefits. I do get that question quite often. And that's always a good one, but yes, you only get one benefit when it comes to Social Security. All right, so I'll answer one more question here. Let me scroll through here. Yes, the Roth. Okay, question on Roth conversions. So you are allowed to do as much Roth conversion as you want. So the key here is that when you don't have earned income, you can't contribute to an IRA anymore. Like if you retire and you're like, oh, I want to go ahead and keep putting money away in my IRA, you can't do that. You have to be retired. You have to have earned income from a job. So in order for you to do that, you need to go back to work. You can't put any more money in, but that doesn't mean that you can't do Roth conversion. So we have some folks that we've worked with that have $3 million or more in IRAs, and we might be doing $300,000 or $400,000 a year in Roth conversions. Because again, I showed you that chart. The Roth conversions end up saving you money down the road. So again, it doesn't help everybody, but it helps everybody that has over a certain amount. And the analysis is free. So this is a free analysis. It's a free resource for you. If you decide to use it for us, we provide that for you. Now, just so you know, I mean, we're providing it to you for free in hopes that we get you as a client, right? I mean, we do have a motive here to do this. We're not a charity, but we do provide that to you. If you feel like we did a great job and things look great, and you might say, geez, I'm really looking for somebody to go ahead and convert my assets into a paycheck. That's what we do. We help folks go from non-retirement to retirement. And part of that is converting whatever you've saved into a paycheck. And there's many ways we do that. If you're interested in that, we'll take care of that at the meeting that you set up with us potentially. All right, so we'll end here just a few minutes early. Thank you for attending. If there's anything else that you need, feel free to shoot us an email, and we will see you on the next call. Thank you.